Welcome to Talk Tickers, your shortcut to the most important insights from the latest earnings calls.
Hey there.
Today, we're jumping into Modine's fourth quarter and full year fiscal 2025 results.
And critically, their outlook for fiscal 2026 as well.
Yeah, this one's pretty interesting. The call highlighted some, well, pretty remarkable results.
Definitely. Especially given the broader environment, it feels like a tale of two segments almost.
A strategic transformation, clearly paying off in some spots, but facing real headwinds in others.
Exactly. So let's unpack what really drove these numbers.
Okay, let's hit the headlines first. Full fiscal year 2025. Get this. Third consecutive year of record sales and profitability.
That's quite a run. Sales were up, what, 7% year over year?
Yep, solid 7% growth.
And that filtered down nicely to the bottom line. Adjusted EBITDA, that's their core operating profit metric, saw a huge jump, up 25%.
Wow, a 25% increase on 7% sales growth. That tells you a lot about efficiency and margin.
It really does. The adjusted EBITDA margin expanded significantly, up 210 basis points year over year.
15.2%.
Right. And 210 basis points, just so you know, that's over a 2% improvement in the margin itself.
Okay.
What's really impressive, though, is this marks their 13th consecutive quarter of year-over-year margin improvement.
13 quarters, wow.
Yeah, reaching the highest adjusted margins since they started this whole strategic transformation. That shows real sustained progress, you know?
Absolutely. And they finished strong, didn't just crawl across the line. Q4 looked good, too.
Very strong finish. Sales up 7% again in the quarter.
But adjusted EBITDA surged 32%.
Pushing that adjusted EBITDA margin even higher in Q4 to 16.1%, that's a 300 basis point improvement versus last year.
And adjusted earnings per share
Came in really healthy, $1.12, up 45%.
So yeah, you could definitely feel that positive momentum the confidence management had on the call, reflecting this strong performance.
For sure. The overall picture looks great.
All right, the total numbers are impressive, especially that margin story. But like you said, the real action is often beneath the surface in the segments.
Exactly. Let's dive into Climate Solutions first. Another outstanding year for them. Frankly, a record-breaking performance.
How good?
Full fiscal year 25 revenue in Climate Solutions increased by, wait for it, 30%.
30%.
Yeah. Now that does include the benefit from the Scott Springfield acquisition, SSM.
Right. Got to factor that in.
But even adjusting for that, the underlying organic growth was really substantial.
And profitability kept pace.
Oh, yeah. Adjusted EBITDA for Climate Solutions surged 45%.
Wow.
Pushing the segment margin up by 220 basis points to a very strong 21%.
21% margin in that segment. That's powerful.
And Q4 just kept that train rolling. Sales up 28%, adjusted EBITDA improved an even better 48%.
And the margin?
Hit 21.4% in Q4, another 290 basis point jump year over year.
Okay, so what's the engine here? What's driving this?
One word, really, data centers.
Figured as much.
Absolutely. Data center sales were up a staggering 119% in fiscal 2025.
Whoa. Okay, 119%. What's the dollar figure on that?
Reached $644 million. This number really jumped out.
Yeah, no kidding.
And they broke it down, which was helpful. About half that increase, roughly $225 million, was organic growth.
So existing operations winning more business.
Exactly. The Scott Springfield acquisition chipped in the other, call it $197 million.
And demand.
They described it as extremely strong, heavily concentrated in North America right now.
Makes sense. They mentioned a new win too, right?
Yeah, a big one. A significant new win with a hyperscaler, one of the giant cloud companies for AI infrastructure.
AI-specific cooling needs.
Right. They called it a multi-phase, multi-location project. Big deal.
So how are they handling this boom, all this demand?
They're ramping up hard, drastically increasing production capacity in North America, specifically Rockbridge, Virginia, and Grenada, Mississippi.
What are they actually doing there?
Adding new chiller lines, end-of-line testing capabilities. The goal, they said, is to more than double their North America capacity.
Double capacity in North America. That's a big investment. Betting on that demand sticking around.
It's a huge bet, yeah. Responding to orders already in hand and what they see in the pipeline.
They also launched something new, didn't they? A modular solution.
They did. A new modular data center cooling solution. They're getting ready for the first North America order for this thing.
What's the idea behind that?
It's designed to meet that need for high-density cooling, but also flexibility, scalability, rapid deployment. Speed is everything for these data center builds.
So like plug-and-play cooling.
Pretty much. Makes it faster and easier for their customers. They also touched on India.
Right, the expansion there.
Yep, said it's on track. Should launch production in the second half of the year. That'll help serve Southeast Asia and the Middle East.
Okay, so data centers are clearly the star. What about the other parts of climate solutions? HVAC and IAQ.
Right. Heating, ventilation, air conditioning, and indoor air quality. They also had a good Q4, sales up 27%.
What drove that?
Mostly late-season heating demand, plus some improvements in IAQ and refrigeration. They're also active on the M&A front here.
Like acquisitions.
Yeah, bolt-ons. They mentioned the recent acquisition of Absolute Air, which is focused on heating products, and they said they're pursuing others.
Okay, so growth there too, but not everything was up. Heat transfer was down.
Yeah, that part of Climate Solutions saw Q4 sales decline 11%.
Why was that?
Mainly lower volume in some of the more traditional markets, commercial and residential HVAC, commercial refrigeration.
So it really highlights that split, doesn't it? Data centers booming, some traditional HVAC areas softer.
Exactly. A bit of a mixed bag within the segment, but the overall trend driven by data centers is strongly positive.
All right, let's switch gears. The other side of the house, Performance Technologies, PT.
PT.
How did that segment fare? We know there are headwinds there.
Yeah, much tougher market environment for PT. But they showed strong sequential earnings and margin improvement in Q4.
Okay, so sequential means quarter over quarter.
Exactly. Improvement from Q3 to Q4, even if year-over-year sales were tough.
Got it. So Q4 adjusted EBIT margin was 15%.
And for the full fiscal year 25, the adjusted EBIT margin came in at 13.5%.
Which is still up year over year, right?
It is. That's a 200 basis point improvement for the full year compared to fiscal 24.
So even with tough markets, they're improving profitability. What's the key?
It really suggests those proactive restructuring efforts and cost initiatives are paying off in PT operational discipline.
What specific headwinds did they call out?
They're pretty clear. An extended downturn in vehicular markets, cars, trucks.
How long do they expect that to last?
They projected it lasting several more quarters, so no quick rebound expected there.
Ouch. Anything else?
Yeah, delays in EV program launches and ramps, that's hitting their near-term growth expectations for advanced solutions, the EV-related stuff.
So the EV transition isn't ramping as fast as maybe planned.
Seems like it, or at least some specific programs are delayed. And then foreign exchange was also a drag in Q4. Hit sales by about $8 million, or 2%.
Okay, so those headwinds definitely impacted sales numbers in Q4 for PT.
No doubt. Advanced solutions down 12%, liquid-cooled applications down 7%, air-cooled applications down 13%. Pretty much down across the board.
But despite those sales declines.
Right. Despite that, their adjusted EBITDA in PT actually improved 5% in Q4.
Improved on lower sales.
Yep. And the margin increased by 220 basis points year over year in the quarter.
That's impressive cost control. How are they managing that?
Well, they're responding actively. They're reorganizing PT into two product groups now.
Okay.
One is heavy-duty equipment, think off-highway machinery, stationary power generators. The other is on-highway applications, that's automotive, commercial vehicles, specialty vehicles. Both ICE and EV stuff in there.
So trying to focus resources better.
Seems like it. They're also streamlining operations, pushing further cost reductions across PT. They expect over $15 million in annual savings from these new actions.
Makes sense.
And crucially, they mention redeploying resources to climate solutions where possible, shifting focus to where the growth is booming.
Smart move. Putting resources where the returns are highest.
Exactly. And this focus on cost and efficiency, using things like 80-20 principles, has really worked for PT margins over time.
How much improvement have they seen?
They said they've improved adjusted EBIT margin by 800 basis points over the last 3 years, even with flat or declining revenue in the segment.
800 basis points. That's huge.
It is. And they reiterated their commitment to the Investor Day margin targets for PT despite these tough market conditions. They're focused on controlling what they can control.
Okay, shifting back to the total company view.
Yeah.
Beyond the segments, how did the overall financials look? Gross margin.
Gross margin saw a really nice improvement, up 350 basis points to 25.7% in Q4.
What drove that big jump?
A combination of things. Higher volume overall obviously helps. Favorable product mix, meaning more sales from higher margin climate solutions.
Right.
And those restructuring and cost savings initiatives really kicking in, especially the impact from PT's efforts.
What about SG&A, selling, general, and administrative costs?
They are investing there. Incremental SG&A to support that massive growth in climate solutions. Plus, Q4 SG&A also had some expenses related to integrating the Springfield acquisition.
Understandable. How about cash flow?
Free cash flow looked pretty solid, $27 million in Q4, and that included about $6 million in restructuring payments.
And for the full year?
$129 million in free cash flow for fiscal 2025. Strong number.
And the balance sheet. Debt levels.
Balance sheet looks very healthy, actually. Strengthened. Net debt is down $92 million from last year, sitting at $279 million.
What's the leverage ratio look like?
Low, 0.7 times net debt to adjusted EBITDA. Very comfortable level.
Gives them flexibility.
Absolutely. And they anticipate another year of excellent free cash flow in fiscal 26. Plus, they announced that $100 million share buyback program.
Did they start using it?
Yep. Completed $18 million worth of buybacks in Q4. So strong financials underpinning everything.
Okay, that sets the stage well. Let's look forward now. The outlook for fiscal 2026. What did management guide to?
Well, first, they definitely acknowledged the current environment. Volatility, uncertainty.
Yeah, tariffs, global economy worries.
Exactly. So because of that, they provided wider than usual guidance ranges, and they plan to give quarterly updates as things evolve.
Makes sense. Speaking of tariffs, did they quantify the potential impact? It's a big concern for many industrials.
They did address it. Their current estimate is that less than 10% of their annual purchases would be subject to the new tariffs based on their regional supply chain setup.
Okay, less than 10%. That sounds manageable.
And they also pointed out that for many customers, their commercial agreements already have clauses that address tariffs on finished goods.
Passing it through.
Potentially, yeah. And they actually framed their global footprint as a potential advantage, helping customers navigate sourcing challenges, which they think could even lead to some incremental revenue opportunities for Modine.
Interesting angle, turning a headwind into a potential tailwind.
We'll see. They put an appendix in their slides summarizing tariff exposure, too.
Good transparency. Okay, so what are the actual guidance numbers for fiscal 26? Top line.
Total company sales expected to grow between 2% and 10%. That's the range.
2 to 10%. And how does that break down by segment?
Big difference. Climate Solutions sales are anticipated to see really robust growth again, between 12% and 20%.
Driven by?
Primarily that strong outlook for data centers still, and also commercial IAQ.
And within Climate Solutions, specifically the data center piece, how optimistic are they there for FY26?
Still incredibly optimistic. They anticipate revenue growth exceeding 30% for data centers in fiscal 26.
Over 30% again. Wow.
Yeah, they are seeing absolutely no slowdown in North America. The challenge there, they repeated, is simply keeping up with demand.
What about Europe?
Europe seems to be adjusting a bit to some changing hyperscaler plans, maybe some pauses or shifts there, but overall global data center demand remains very high.
Okay, so Climate Solutions strong. What about Performance Technologies?
That's the other side of the coin. PT sales are anticipated to be down between 2% and 12% for fiscal 26.
Down 2 to 12%. Why the decline?
It's based on the assumption that those end markets, vehicular off-highway, will stay depressed, and also that ongoing trade conflicts could negatively impact any potential recovery there.
So a real split forecast for the two main segments, growth in one, decline in the other.
Exactly, a clear divergence.
But despite that revenue decline baked in for PT, what's the overall earnings outlook, adjusted EBITDA?
Still quite strong, actually. The guidance range is $420 million to $450 million for total company adjusted EBITDA.
Okay, $420 to $450 million. What's the midpoint growth look like?
The midpoint represents an 11% increase year over year.
11% earnings growth, even with one segment's revenue declining. That's interesting.
It indicates they expect another year of solid earnings growth overall, powered largely by that high margin growth in Climate Solutions, plus continued margin execution in PT, even on lower sales.
And they feel they're on track for longer-term goals.
Yeah, they reiterated they feel they're on track for their fiscal 2026 and even their fiscal 2027 goals laid out previously. They also mentioned some reporting changes coming up, right?
Yes, how they'll report the segments going forward.
Exactly. To better reflect their strategy, Climate Solutions will now be split into 3 reportable groups.
Which are?
Data centers and commercial IAQ, then HVC technologies, that's heating and school IAQ, and finally heat transfer solutions, coils, coatings, commercial refrigeration.
Makes sense, separating those out.
And
performance technologies.
That'll be split into 2. Heavy-duty equipment and on-highway applications, matching that internal reorganization they talked about.
Okay, and they'll provide historical numbers in the new format.
Yep. They said they'll provide a restatement of fiscal 25 figures based on this new structure. That'll be really helpful for modeling purposes.
Definitely. Okay, let's dig into the Q&A a bit. Any interesting tidbits or clarifications that came out during the question and answer session on the call?
Yeah, there were some good ones. Visibility in data centers was a key topic.
How far out can they see?
Well, they mentioned having relationships with 5 hyperscalers now. And some customers give them visibility out, believe it or not, up to 5 years.
5 years. That's incredible for industrials.
It is, but they qualified it. Their high confidence level is really for the 1-year outlook. Moderate to high for 2 years out. Still, that's pretty good visibility.
Better than most, yeah. And what about that North America capacity versus demand picture? They elaborated.
Yes, this was critical. They confirmed demand in North America currently exceeds their capacity there.
So the bottleneck is real.
Very real. And that's exactly why they're doubling capacity in Virginia and Mississippi. Their global capacity is over $1 billion. But the constraint holding back North America growth right now is that regional manufacturing footprint.
Okay, so how does that bottleneck affect the timing of data center revenue in fiscal 26, the cadence through the year?
They expect Q1 to be the softest quarter for data center revenue.
Because the new capacity isn't fully online yet.
Exactly. They're still ramping it up. So revenue is expected to build throughout the year. They should be better able to keep up with demand by the second half of FY26.
Any other factors hitting Q1?
Yeah. They also mentioned seeing some volume declines in Europe, specifically in Q1, which adds to that slightly slower start to the year for data centers overall.
Okay. Did they break down the climate solutions growth outlook beyond just data centers, like the other parts?
They did give some color there. Data centers, as we said, expected over 30% growth. The heating and school IAQ business, which they size as about a $200 million business, is projected for low double-digit growth.
Okay, low double digits. Still decent.
Yeah. But heat transfer, the coils, coatings, commercial refrigeration side, that's projected to be flat to maybe down slightly. 0 to minus 5% decline.
Why the weakness there?
Visibility is lower, for one. The market apparently has excess coil capacity right now, and they even mentioned some customers are insourcing production, making it themselves.
Ah, okay. So definitely a mixed bag within climate solutions, but heavily skewed positive by the data center monster growth.
Precisely.
What about that potential divestiture? The Performance Technologies automotive business. Any update there?
Yeah, they confirmed that business, it's around $200 to $250 million in revenue, is included in the full FY26 guidance numbers we discussed.
So no assumption of a sale in the forecast yet.
Correct, but they did say they're focused on executing a single transaction for this exit. And management sounded, I'd say, like they're gaining more confidence they can actually get that deal done this fiscal year.
Okay, something to watch then. Any other divestitures planned?
Nope. They said no others are built into the guide. The prior ones, like the air-cooled automotive business, are now completed and anniversaried.
Got it. What about margins for FY26? How do they get that total company earnings increase with PT revenue expected to be down?
Good question. The implied total company incremental margins, how much profit they get from each new dollar of revenue, are around 28% at the midpoint of guidance.
28% incrementals. How does that break down?
In PT, even with revenue down, they expect margins to improve by 125 to 175 basis points, driven by those cost reductions and 80-20 efforts.
So PT still contributes to margin expansion overall.
Yes. Meanwhile, climate solutions margins are expected to be relatively flatter, maybe around that 20% mark, perhaps slightly higher.
Flatter margins in climate solutions. Why?
Likely due to reinvestment for all that growth, the capacity expansions, SG&A to support it. But the key is the high growth rate in climate solutions. Even at a flat margin percentage, the absolute dollar amount of earnings coming from that segment grows significantly because the revenue base is expanding so fast.
Right, makes sense. That high growth swamps everything else.
Exactly. That's what drives the total company earnings increase.
What about that new modular data center solution? Did they clarify if that opens up new markets or just helps existing ones?
Yeah, they clarified it doesn't necessarily unlock a completely new total addressable market, or TAM. But what it does do is solve a critical customer need: speed and convenience. By doing more assembly and testing in-house, they offer a more plug-and-play system.
Which customers value highly.
Hugely. It accelerates deployment for them, which is a massive value proposition in the fast-moving data center world.
Okay. And one last thing from the Q&A. How are they feeling about that longer-term target? The fiscal 2027 goal of hitting $1 billion in data center revenue.
They said their confidence in hitting that billion-dollar target has actually increased.
Increased. Why?
They pointed directly to their focus on execution now, and specifically that huge North America capacity build-out that's underway. Getting that capacity online is key.
So it's all about execution for the next couple of years.
Exactly. They stress the near-term focus, the next 24 months, is squarely on executing these expansion plans.
Okay, wow. We've covered a ton of ground here, from, explosive growth in one area to navigating really tough markets in another.
It really highlights the diverging paths within this single company right now, doesn't it?
It absolutely does. Which I think brings us nicely to that segment where we just like to think out loud a bit, maybe get a little creative.
Ah, yes. The part where we put on our imaginary trader hats, but preface it with a giant flashing sign that says,
Not.
"This is not financial advice."
Exactly. We're just taking the raw ingredients from the call, stirring them up, and seeing what kind of wild but maybe plausible investment ideas might bubble up.
For discussion purposes only, always, always, always do your own research. Talk to a professional financial advisor before making any investment decisions.
Got it. Got it. Crystal clear disclaimer.
Yeah.
So, what's the idea this time?
All right. Lay it on us.
Yeah.
Based purely on what we heard on this Modine call, what's an outrageous but plausible idea someone might concoct?
Okay, consider the setup. You've got this incredibly clear picture, right? Accelerating high-margin growth in North America data centers. Just booming.
Right.
Contrasted directly with depressed, uncertain vehicular and off-highway markets hitting performance technologies.
Okay. The divergence we talked about. Exactly. So the idea, a pair trade, playing that exact divergence.
Pair trade. Okay, how
Yeah.
would that work? Long one, short another.
Precisely. You go long Modine equity, or maybe if you want some leverage and are confident on timing, you look at call options.
And the bet on the long side is?
The bet is that the acceleration of that North America data center capacity ramp up through fiscal 26 happens smoothly, maybe even faster than the market expects, driving upside beyond the current guidance.
Like hitting the high end of that 30% data center growth forecast.
Or maybe even exceeding it, increasing confidence in that FY27 $1 billion target even sooner than people think. That's the potential upside catalyst.
Okay, that's the long Modine side. How do you fund it in a pair trade? What's the short?
You fund it by shorting shares or maybe buying put options on a different industrial company, a peer.
Which kind of peer?
The key is finding one with significant exposure to those exact challenged markets Modine called out vehicular, off-highway.
Okay.
But crucially, a company that lacks a comparable high-growth, high-margin engine like Modine's data center business.
So no similar strong offset to the weak markets.
Right. Or maybe a company that doesn't have as clear a strategic restructuring path or a planned divestiture like Modine's potential automotive exit to improve margins or refocus the business.
So you're betting on the relative performance. Modine outperforming this hypothetical peer.
Exactly. Leveraging Modine's specific strengths, the data center boom, the restructuring gains, the potential divestiture against a peer's vulnerability to the market downturns Modine is also facing, but without the same positive drivers.
And you mentioned Modine's balance sheet and buyback earlier.
Yeah, those could be seen as sort of layers of safety or additional potential catalyst for the long Modine side of the trade, that low 0.7 leverage, the ongoing share buyback program. The shorted peer might not have those advantages.
Okay, it makes sense conceptually. But what are the risks here, keeping it grounded in what we heard on the call? What could go wrong with this trade?
Well, the biggest risks are tied directly to Modine's execution, which they themselves highlighted. Can they execute flawlessly on that massive North America capacity ramp? Building and staffing facilities quickly is never easy.
Execution risk, got it.
What if that performance technologies market downturn gets even deeper or lasts significantly longer than they currently anticipate? That would hurt Modine too, even if less than hypothetical short tariffs. Could they have a larger impact than that sub 10% estimate? Maybe. Integration risk on any bolt-on acquisitions they do in climate solutions? And importantly, what if there are challenges or significant delays in executing that planned automotive divestiture this year? That could disappoint expectations.
So plenty of potential pitfalls tied directly to the factors discussed on the call.
Absolutely. And the outrageous part of the idea might just be how aggressively someone times the bet on that North America ramp unlocking value, or maybe the specific peer they choose for the short leg.
It really does illustrate how different parts of the industrial economy seem to be moving in almost opposite directions right now. Very interesting thought experiment.
Just a thought experiment. Again, not advice.
Definitely not advice. Okay, let's wrap this up.
Sounds good. So, to recap, Modine delivered a third straight record year, really powered by exceptional performance in climate solutions, especially data centers.
While also showing impressive margin execution in performance technologies, even though that segment faced some serious market headwinds.
The outlook points to continued growth overall, mainly driven by climate solutions again, backed by those major capacity expansions needed just to keep pace with that seemingly insatiable data center demand, particularly in North America.
Challenges definitely remain in PT, but the restructuring efforts seem to be working on the margin front, and strategic portfolio actions, like that potential automotive divestiture, are progressing.
Management signaled a clear focus on controlling what they can control amidst all the global uncertainty, and they sounded pretty confident in hitting their medium-term financial targets.
Okay, and our standard closing reminder. This information we shared today is purely for your information and for discussion. It is absolutely not financial advice.
Please, always do your own thorough research and consult with a qualified, professional financial advisor before making any investment decisions.
So, thinking about everything we just talked through, what stands out most to you from this Modine call?
Does it change how you view the industrial landscape, maybe? Or the sheer pace of this data center build-out we keep hearing about? Something to chew on.
Definitely something to think about. We'll be back soon with another deep dive into the latest earnings calls. Thanks for joining us on Talk Deckers.